Hi.
How are you?
Doing well. Doing great, actually.
You are?
My kids slept through the night last night.
Get out of town.
Like, if you haven't heard me complaining about my kids yet.
All I've heard, since you had kids, all I've heard is that they don't sleep, they don't sleep, they don't sleep. Aren't they like 25 now? How old are they?
It feels like it. They were 6.5 is the oldest, and I can count on my hands how many times I slept through the night. So I slept from 8:30 p.m. to 5:30 this morning. I thought about getting up and riding my Peloton, and then I went, you know what? Nah. And I went back to sleep until they woke me up at 6:15.
Oh my gosh.
So look out. I got all the energy to.
Wow. Congratulations.
Yeah, I know, right?
That's a huge
throw
thing.
A party.
You think it'll keep up?
Of course not.
Yeah. Well, maybe. You can hold out hope. But they both slept at the same. They have like a pact.
I don't.
They decided to okay, we'll sleep tonight.
I do feel like they have a pact because it's either one or the other, the 6-year-old or the 3-year-old, in my room at 12:30 every night.
You should burn their schedule. They obviously have a schedule. They're coordinating, right? You torment her tonight. I want to sleep in.
Feeling good. Finally.
Yeah. Well, congratulations. I had the same thing. My second daughter. Oh my gosh. Daddy. Every time I was like 3 a.m, I'm like, you don't need to wake up. Yes, I do. She was the worst.
I'm scared. It's dark.
She's now a veterinarian, so I mean, it works out.
I guess so.
Yeah. Okay. So before we move on, I want to just tell the audience that Medicare is making Medicare drug plans are going to in 2025. They are going to have a maximum out of pocket of $2,000.
Oh my gosh.
Per beneficiary. Right now, amazing. The maximum out of pocket is like $7,050 per person, plus another 20% of the excess. So I mean, you can imagine it could be if you're taking expensive cancer treatments or that new Alzheimer's drug. If they get to do it, it could be. There's unlimited how much you can spend, right? So to cap it at $2,000 a year.
This is law.
It's enacted, but it's going to take effect in 2025. However, next year, if you take insulin, you're going to be capped at $35 a month in your cost. That's it.
That's huge.
Huge, yeah. Big changes for older Americans.
Amazing.
It's great.
Amazing.
It's great. Much more security. Okay, so welcome to A Place of Possibility. We are happy to have you here with us. I am Richard Del Monte.
I'm Angela Wright.
And what are we talking about today?
We are talking about homeowners insurance.
Homeowners insurance.
Now, before you roll your eyes and click away, like, oh, snooze. You should know that if you ever have a claim, you might not be covered in the way that you think that you are. You might be underinsured, kicking yourself. Like, you just never know. And it's something that you need to think about and talk about regularly. You also need to know what questions to ask your insurance carrier.
Yep, that's right. And of course, if you live in California, I'm sure the wildfire risk is not far from your thoughts, because a lot of people have been getting their homeowners insurance canceled, yours truly included. And we're going to help you become smarter insurance consumers with this broadcast today. So
yes, and we have an awesome guest to help us out.
Yes, we do.
He is a great friend of Del Monte Group, my personal insurance agent
and mine.
Broker, actually.
Yeah, right. Yeah.
And his name is Brian Trouette with Trouette Insurance Agency. He serves Bay Area, California, all over California, actually, and has an office in Scottsdale, Arizona as well.
Yep. And if I didn't know better, here he is. If I didn't know better, I would think that Brian was an attorney. Are you an attorney?
No, I'm not.
Okay, but I would think you're an attorney because you know these contracts, these insurance contracts, better than anybody I've ever talked to. The language, and we all know, though, you get the policy every year in the mail. It's like, throw it in the garbage. Who knows what it says? He knows what it says. It's amazing.
Yeah.
So, and plus he's really entertaining. So we're happy to have you, Brian.
Yeah, no pressure to be entertaining about insurance.
For being here.
Yep. Welcome.
How are you?
I'm doing great. You're doing great. I'm in sunny Scottsdale today, so broadcasting from Pinnacle Peak area today.
Oh, nice.
Well, we really appreciate you dressing up for us on this broadcast.
Hey,
do you have to get out of your swimming trunks to be able to be on this
clothes?
Yeah. Do you just go to work with shorts on all the time? What happened? How does it work there in that state? You do.
Everybody does. Even attorneys, you'll go to a meeting with attorneys and bankers and financial advisors. Everybody walks in wearing shorts and golf shirts.
That's kind of nice. Well, because I feel like you just go right to the golf course after work, right?
That's right.
Yeah.
That's right.
Wow.
You have to pick. There's so many between my house and here where my office is. You have to kind of pick the golf course you want that day, so you don't.
Oh man,
that's awesome.
Tough.
That's awesome.
That's real tough.
It's a terrible life. I hated it.
Yeah.
All right, let's start off by talking about something that you discuss on your website. You mentioned that people move through their careers, they accumulate more wealth, and they're not always aware that they're becoming underinsured. What do you mean by that? How does this happen?
Yeah, so this conversation happens a lot for me where, even this week I had the same conversation. I'm going through I do a spreadsheet analysis for a client, and that's how we onboard a client. And as I was talking through how his insurance works, he said, I should tell you that I haven't ever looked at my insurance in the last 30 years. We bought a policy when I graduated from college, and the only time we've ever done anything with it is when we have to touch it. We bought a new house, we bought a new car, our kid got her driver's license. He's like, I've never really paid attention. And people always say that kind of sheepishly, right? And I'll say, you're not alone. I usually meet people about where you are, where their financial advisor has said, it's time for you to start learning how to play defense on some things. And what happens if your house burns down? And what happens if someone files a lawsuit against you? And so there's this drift. Even, people might buy something and they keep it for a long time. And this drift occurs where the carriers change their policy forms and their house is worth more. And they've changed their lifestyle, but their insurance stays flat. And so that's something that we correct, or we advise on correcting. And the whole insurance business is a sales process. So if you think about everything that's on that about insurance is probably from watching insurance advertisements with lizards and the lady who's got this
that's right,
kind of weird relationship with a guy who likes her, but she's trying to sell him insurance, Flo, and like it's humorous, and there's songs, and it's like my kids are always like, bump it, bump, bump, we are farmers.
Yeah.
We're really not farmers, but you're not sold anything but brand. They sell insurance like Budweiser sells beer. So in the absence of anything that's meaningful, what people do is just take a couple comparison points, like on price and a number, and then they pull the trigger and they move on with their life. That's what happens.
Yeah, it's amazing that it even works, that system works with that kind of decision process, right?
Well, I think
Just
it
price.
doesn't a lot of the time.
Yeah.
Well, it doesn't work, as a matter of fact. Yeah.
Yeah. So let's talk about some of the biggest mistakes or problems that you see when you review your new clients' insurance portfolios. What shows up all the time?
Well, the number one issue that we see is replacement costs. So most people are interacting with the insurance industry in what we call the middle market. Those are mass market carriers that appeal. Those are the advertisers, right? From GEICO, that's designed for really kind of lower income, price conscious people, to State Farm, that's like sort of the Cadillac of direct writer. They're interacting with those carriers, and those carriers use very limited replacement cost calculators. So they'll come up with a minimum replacement cost. After the 2017 fires, I was following a lot of the Press Democrat news, and there was a great article about USAA. He's a very honorable carrier, but the guy who was insured had USAA, and he said, I thought I was insured because I answered all their questions about my home, and I was underinsured by at least 50%. I couldn't rebuild my home because they'll spit out a number. Like yesterday, I looked at one that was insured for, they were going to insure the house for $661,000 in Orinda. And that was $253 a foot that the carrier had shown on their form. This is a Travelers policy. Now, Travelers is a company that we do business with. They happened to show the quote to their financial advisor, and their advisor emailed me and asked me, hey, what would you insure this house for? And I said, yeah, probably $550 a foot to $600 a foot based on pictures on Zillow. So Travelers is just, they're not meaning to be wrong. They just don't know how. There's no system that's very good at saying what your replacement cost is. So he would have been underinsured out of the gate. And then when you add that, carriers often have sublimits. So carriers will design their policies to pay claims that are statistically probable, like you might have a small electrical fire and have a little smoke damage, or a little bit of water comes from a toilet, some kind of a leak from a service line or something. And so you're $10,000-$20,000 of loss. You'll never know about any kinds of sublimits. But when you start having to rebuild a house in a catastrophic loss, where you're hundreds of thousands of dollars because you had a sewer backup, then you find out that carriers only pay like $5,000 or $10,000 of sewer backup. So you have to really read these contracts and know who covers sewer, who doesn't. I say this, so we're talking about fire a lot in California. Fire's not even in my top 3
Really
covered losses. So if you take all of the losses that we have on property, it goes sewer backup, and then it goes other water backup, and then it goes weather, wind, that type of stuff. Fire is probably 4 or 5 in terms of, because our underwriting is so good. In California, all of the carriers have gotten off areas where you could lose houses. So we haven't lost a house in California since 2017.
Whoa.
To fire. But every year I have 2 or 3 claims that are hundreds of thousands of dollars on sewer backup or water,
So years ago, they used to have something called, what my understanding was, guaranteed replacement costs, right?
Yeah.
And whatever it costs to replace your house, they were going to cover it. What happened to that?
So mostly that went away in the Oakland Hills fire.
In 1991
remember,
or whatever.
Yeah, if you remember that, it was like back in it was the late 80s. It was 89, maybe. Anyway, whatever it was.
Yeah.
And what happened was all these carriers or agents would go to someone and say, "Hey, Angela, I can save you money on your insurance. You're insured for $1 million, but I'm going to lower that to $800,000, and we're going to put this rider on it for guaranteed replacement cost." And you'd be like, "That sounds great." So they lowered your premium. Then the next agent would come along the next time and be like, "I'm going to lower your premium down to $700,000. So It was this kind of race to the bottom. There wasn't a single home in the Oakland Hills fire that was insured to value, because all of these homes, they've been playing this game of the guaranteed replacement cost. So that rider went away in California for the most part, and it's completely gone now. There's not a carrier who will write guaranteed replacement costs that I'm aware of in California at this time, because people like to play games with their replacement cost. And the carriers want to be insured to value, but a lot of agents don't know anything about home value, and neither do adjusters. These are just kids who get a job out of college and they're given a computer, so.
Yeah. So how do you know if you have adequate coverage on your house? So you're talking about this house in Orinda that wasn't adequate. They're giving us national averages. Like we've seen an 8% inflation rate in the economy overall. If you've tried to do any work on your house in California, you've been confronted with jaw-dropping prices.
Yeah.
I mean, how do you do this, and who's responsible for keeping the coverage current? Like consumer, carrier, agent?
Ultimately, contractually, the consumer is responsible for the value of their home.
The one least capable of knowing what it is.
Absolutely, yeah. Well, actually, you'd be surprised how incapable a lot of insurance people are. You don't have to be that smart.
Not really.
There's a test, and you get a 70% on it, and you pass.
Right.
It's not like the exams that you guys took for the certified financial planner or the series licenses.
Yeah.
Those are hard. So, and there's and about 50% of the people who take that test the first time fail. So I'm telling you, it's terrible.
Wow.
But I talk to a lot of contractors in the area. So, if you were going to build a house right now, you'd say, "Tell me the level of trim that you're going to do. Are you going to be putting in granite? What are you going to put in the bathrooms? Is it going to be, tiles? Is it going to be fiberglass?" And then once we know that trim level, we'll say, okay, on a house like that, we're probably looking at $450 a foot, or $550 or $650 or whatever. We know in a class of home what the average cost is in different areas, right? So I know that you can't build anything, even a builder's grade house in Orinda, for under $400 a foot. And in a lot of places in California, and they think, well, we're going to get this price break because we're out in Arnold or something like that. Well, contractors may not want to come out to Arnold. They may be charging you more. Santa Rosa, there was a lady who lost a house up there in 2017, because I do a lot of, the way I know this is I do a lot of pro bono work for the Financial Planner Association. They have the foundation. And so sometimes people who don't have advocacy need help. A lady had her house insured for about $350 a foot in Santa Rosa. And I would have said that house was insured to value, but the replacement cost, even without demand surge, ended up coming in closer to $450. So Santa Rosa is the Bay Area. All of Northern California pretty much is, until you get really far north. We're talking, like
Eureka or something.
If weed is still there, like I think it burned
it
down.
was on fire recently, right?
Yeah. Well, what about the fact that when an area burns down like Santa Rosa, all the prices go up because there's only so many contractors, right? What happens then? I can imagine the price per foot goes way up.
Oh yeah, we were seeing houses. Rebuilding at 180 to 190% of the insured value, the true value. So if you were $1 million home, you would have rebuilt for 1.8 or 1.9. In fact, AIG, their rep called me in 18 and said, we're really worried that we might exceed our 200% extended replacement cost on some of these homes because the demand surge was so high. And then we had people who might have been insured to value, but they only had 20% extended replacement cost. So it's all a continuum, right? So if a carrier has, a lot of carriers like Safeco and Travelers, they will give you 100% extended replacement cost if you want it. But agents will sell 50% or 25% because they're saving money and they're trying to close a deal. So you really have to look at what am I buying? And the only way I know of to do that is to take that information and put it into some type of a workbook or something where you can say, here's what I have and here's how it works. And this is what I need to rebuild the house. And then you work backwards from that. It's so much trouble and so labor intensive that most people just aren't willing to do it. So
they end up underinsured.
Yeah, and if you can run out of loss of use, right? So if you only have 24 or 36 months of loss of use and everything is rebuilding at 180%, and you only had 120%, you're talking of hundreds of thousands of dollars that you'd have to come out of pocket. And and like in our space, right, we're all working with clients who are pretty affluent to ultra high net worth. But if you take an average person who may be living on a pension or something like that, maybe they retired from PG&E or they were a teacher and they put all their money into their home and they have a nice lifestyle, they may not be able or want to take out another $500,000 or $600,000 mortgage at the end of their life. And so
probably not.
This knowledge becomes, and that's why I got involved in the foundation, because I feel like this knowledge is a social justice issue, that people really don't have access to this type of knowledge unless they've got people who are willing to volunteer,
So do most carriers have a 200% of cost rider or something on it?
No, they don't. And there's a reason for that. A lot of carriers don't want to have 200% because their policy is designed to protect the carrier in a catastrophic loss event. So when you see a carrier that has a code upgrade sublimit or a low extended replacement cost, what you're looking at is a carrier who has designed their policy to have limitations that protect the carrier in a catastrophic loss. So if you take a house that was built in, say, 1979 or 80, which is very common in the Bay Area, and it's $1 million home, and it has a 10% ordinance and law sub-limit, that means that if they're rebuilding that house, they're only going to give you $100,000 towards anything that's a code upgrade. So if you're forced to replace your foundation or the type of windows because of energy or put on solar or in Danville, they may make you put a water filtration system from your property to the street, that type of stuff.
Really?
And local code is really to get, but Anything over that $100,000, now the carrier will say, "Oh, we're so sorry. That's compliance with code or ordinance, so we don't cover that." So a person could be insured to value and still be out hundreds of thousands of dollars on a rebuild if they don't pay attention to that.
So in a
there's
major fire, like the Santa
Yeah.
Rosa fire, do people just have to wait for years to rebuild because they don't have enough coverage? What
A
happens?
lot of them had to. A lot of them had to cash out, and so
man.
many carriers, like, so there, carriers like Chubb and Pure, and there's some higher end carriers that will offer you cash out replacement costs. Travelers has that on one of their forms where they'll cash you out for the replacement cost of your home. Most carriers are actual cash value policies. So if you don't rebuild, the carrier goes in and depreciates the entire value of the home on a line item basis. And so you have a situation where maybe you were insured for $600,000 on a house, and then they come back and say, "Well, we've done our depreciation. If you're not going to rebuild, we're going to give you 300, but some of that was code and it's not covered because of this." And right, they start depreciating that down. So California passed some laws to try to get around that. And I'm not going to spend a lot of time on the laws because I just taught a 90-minute class on it to a group of financial advisors. But the laws actually made things worse, because what they did was the carriers that weren't very broad form coverage, it doesn't affect them because there's no coverage in their policy. And the coverage that wrote broad form coverage said, this isn't fair and we can't charge what our true risk is now. And so we have this thing going on where there's this flood of business going into the California Fair Plan, which is really terrible coverage. And the Fair Plan, I mean, we had a policy that was canceled by a carrier because the carrier couldn't afford to stay on the policy. They were charging about $2,500 for around $1 million of replacement cost a year. And the carrier's reinsurance carrier was charging more for that policy than the carrier was making. So the carrier was actually paying the client to be their insured at the end of the day. So they got off of it. The carrier applied to our insurance commissioner for a rate increase, and the commissioner said no. So we had to move that into the California Fair Plan. So they were paying $2,500. The California Fair Plan plus the companion policy ended up being around $6,500 in cost. So they have less coverage, three times the cost. And that's all because of legislation that keeps carriers from raising rates in California. So we have some really serious problems that I think would be solvable if we had all of the stakeholders come together, but the stakeholders don't want to. Everyone's stuck in their lane. The insurance carriers can't really negotiate with Ricardo Laura. He is a rhetorician. He doesn't understand the insurance business, I don't think. And our insurance commissioner and consumer advocacy groups can't really come out and say, we think Proposition 103 is a bad thing now because they supported it when it came. You know what I mean? Like, everyone's kind of stuck in their lane. And unless someone gathers everyone together and says, we're all going to negotiate and talk about their needs, and we're going to figure this out, it's going to get worse and worse and worse before it gets better. And the market in California is definitely shrinking. So it's a huge problem.
It sounds like it. So what I'm hearing from this conversation so far is that the system is kind of rigged against the consumer. They put all the onus on the consumer to decide how much they need to have their house insured for, whether they have the right kind of insurance, and it's got 100, if they're covered, if there's a big fire and they're in a big group of people that lost their homes, and all these things are happening, and at the same time they have no help, and they just look at lizards on TV to decide what they're going to buy. So I mean, so it brings up to me, like, how could they possibly go without an agent? And I know this is a little bit self-serving question for you, but I can't imagine how consumers could go direct to the carrier and buy insurance and have any idea or thought that they're covered okay.
I'll tell you what, I mean, we're trained to read these sorts of contracts. We understand, like Richard and I, we understand most of the language, and I wouldn't dare buy a policy without an insurance broker.
Right.
You
I
know,
wouldn't
it's
either,
just, I
but a
would
good
miss
one, right?
something. I mean, yes, Brian, for example.
Yeah.
Yeah, thanks.
You know, not someone that just
Yeah, I know
takes
a guy.
premiums and sends you a thank you card every year or whatever.
Yeah,
you
no,
know.
and I mean, I think even more than that, like when you have a loss is when these guys like really, you know, having them in your
Shine.
corner, it makes a huge difference.
You
right?
kind of had a little experience, didn't you?
Oh
recently?
my gosh. One morning back in May, I walked into my kitchen at 6 a.m. to the sound of squish, and suddenly my foot was covered with water.
Yikes.
Instantly woke me up without the coffee. And I'm like, oh no, this is, you know, looking, did it come out of the dishwasher, out of the fridge? Oh no, it was coming up from between the floorboards. So beep, boop, beep. I call up Brian first because, you know, as a consumer, I'm like terrified of the insurance company, right? If I say the wrong thing when I'm having my claim conversation with them, suddenly it's not covered.
Yeah.
So I call Brian.
You need to have a lawyer with you. Lawyer up, I
Seriously.
know, right?
So by 8 a.m., there's a claim opened with my carrier. Ryan has, you know, coached me. Here's what you need to do. Here are the steps you need to take. You know, 5 minutes later, there was like a restoration company in my house packing up my kitchen and ripping the floor out. I mean, had I not had somebody in my corner, like if I had a farmer's agent, they would have said, oh, go online and open a claim.
Yeah. Here's
right?
the 800 number to call. Right? Yeah.
Yes. So, I mean, I think it's super valuable to have somebody.
There's a lot of good insurance brokers out there, right? There really are. Just like there's a lot of good financial planners. I mean, there's only one.
Actually, we're the only good one.
Possibility. I mean, there's some okay ones outside of you guys, right? But the real, I would say you want to ask a list of questions, and one of them is, you know, who do I call for service, right? So if I buy a car, who am I calling? Am I calling the carrier? Or am I calling you? If I have a claim, is your office going to help me with this claim, or am I going to get stuck with the service center over at Nationwide who, you know, now I have to learn how to speak insurance. And that's really the biggest issue is, right? Like I can get something done in 5 minutes that might take you days because I speak this language. And that's why I was coaching you of what not to say, is because I was afraid you might say something that would be an exclusion on the policy, and we weren't sure exactly what the cause was, and I didn't want to go down that road unless we knew for sure, right, that it was something, because I don't want them to guess wrong on the carrier side. So speaking insurance is a very powerful position to be in when you're dealing with an adjuster, and you really do need advocacy. And it's funny because I don't speak your financial language. I speak it enough to understand what I'm being told, but I don't speak it enough to actually do what you do. And so, you know what I mean? Everybody's got their specialties in our world. And I think that's the way it needs to be. You've got to hire someone who's going to do it. And it doesn't cost more to use someone who's knowledgeable because we're all paid the same way. So I think it makes a lot of sense to interview them and ask, what services are you going to provide? Are you going to be there to help me? And it's a fair question.
So a great broker / agent would be someone that helps you design the policy properly for you, understands the risks, and make sure you have enough coverage. That answers your questions while you're a policyholder, like, hey, this is happening. Do I have to worry about it? And also kind of acts like a coach or helps you through the claims process, right? Like a mentor through the claims process. Is that right?
Yeah.
I'd rather have a lizard. But it's okay.
Yeah, I know. You know what?
It sounds
it's a gecko, Richard, and I know.
I know it is.
They're cute, man. I mean,
they're cute. I know, but you know. But I mean, it sounds like, again, I can't even imagine not having a good insurance.
You know, I got to be honest. I didn't really understand the value until I went through the experience myself.
Yeah.
And I mean, isn't that life, right? Like wisdom. Teaches you.
Yeah.
And Brian and I were joking at one point, like, does this adjuster get paid a bonus based on how little she pays me? Like at every turn, no, that's not covered. No, can't do that. No, you got to go stay in a hotel room with your 2 kids and no kitchen. there was Brian. Nope, you got to put her in something like the house she's leaving. And you just like, I didn't know what was possible or what was available. And I certainly, in the midst of my toddlers and my job and my kitchen blowing up, wasn't going to grab my policy and start reading it.
Yeah. And it's not like you're paying a bunch extra to have an agent take care of you, right? It's built into the policy.
No, it's built in, but like, if you're calling GEICO or something like that, those are direct writers. So, they're designed to pay less, but they know, like, on average, the carriers that we use are going to pay more in a claim. Like, for instance, if we're using Safeco pays out on average higher on a claim than GEICO will, because if I'm involved in advocacy, I might say, hey, that car was not in average condition. It was in pristine condition. Richard had that in his garage and he only drove it, his office is 5 minutes from his house, and on and on and on, low mileage. And so now the carrier's having to pay out more. When there's advocacy, it means the carriers pay out more. They would love to get rid of us, the guys who, like me, because I cost them a lot of money. I make them a lot of money, but I cost them a lot of money too.
Yeah. Oh man. There's a couple other things that we wanted to cover today. So, excess liability or umbrella coverage, just kind of switching gears here. A lot of people don't think about this. Like, oh, I got, $500,000 insurance. I'm good. What is it? Who needs it? How do you calculate how much you need?
So it's a great question. And so I'm going to start from the base policy. There's a coverage that I look at on every policy that's missing on almost every policy that we review. And it's called personal injury coverage. So, or personal offense, they call it different things. It's not on most policies. You have to endorse it on. State Farm, Allstate, Farmers, any company that you can name outside of like Chubb and those, typically you have to add that coverage on. And the reason it's not on there is because as social media took off, people started publishing their opinions and suing one another. Personal injury is libel, slander, false arrest, but it's also cyberbullying. It's, there's a big lawsuit that was going on in the Danville, San Ramon School District, where some young women had taken pictures of each other. And then one published a picture of her in a compromised position, and now all the families are suing. As the carrier is asked whether they're going to respond or not, they look for that personal injury coverage. If you don't have that, you're on your own. So personal injury is a big deal, because if your kid gets involved in a cyberbullying incident, they may not even be the perpetrator, but because they're on that Snapchat, because they're listed on somebody's phone, now you have been drawn into a lawsuit. So it's very important, especially if you have kids, to make sure that you've got personal injury coverage. So if you use up the coverage on your home or your auto policy, you go into excess liability coverage. Umbrella is what most people call it. And it's a way of aligning your interests and the carrier's interests. You align a carrier's and your interests by having enough for them to lose that they care about a claim. So if you have a high net worth family with $1 million of umbrella and somebody was killed in an auto insurance accident, or they broke their neck diving into your pool, the carrier may just pay out $1 million. Every policy reads, our duty to defend ends when we've paid out the limit of our liability. So on $1 million policy, they can say, why spend $400,000 defending Richard when we know we're going to? When we know we're going to spend. When we know we're going to spend $1 million, let's just spend $1 million and get done and not have to hire an attorney. So that's what they'll do. And so then, you have a $5 million umbrella. All of a sudden, that Richard Del Monte is not such a bad guy after all. And they were going to defend him. I mean, that guy should have known better than to dive into his pool. I mean, the attitude is amazing. And so I'll usually align, so someone who has like $1 million or $2 million of net worth, I'll usually, total with their home and everything, I'll usually bump to like 5 million, because that makes the carrier defend the carrier's own money, right? They're not defending your money, they're defending their money. And it's a completely different attitude. And if they go above 5 million in net worth, I'll usually jump to say 10 million if I can, in a carrier that will do that. because at $10 million, the difference between 10 and 5 really is like a few $100s. So you're not talking about very much money
In
to have
premium.
yeah.
Okay.
To have a carrier have your interest at heart. When you're above 10 million, you start talking about cost to value because it's a different class. You know, someone with $20-30 million net worth, we start to talk about cost of value and, you know, where their assets are located, things like that. But, you know, that's a little bit different conversation. But for the people in that $5 to $10 million net worth, which comprises a lot of people in our world, that's my thinking on liability and who should have it. And, you know, personal injury attorneys, Richard and I know a really good one in our in a group that we're members of. And, you know, her and a lot of her colleagues have told me that when there's an umbrella, personal injury attorneys will go after that money instead of going after someone's house, forcing them to sell a home or something, because it's easier money. It's very difficult to have to force someone to sell a home. But I mean, things happen. Kids are shooting like, you know, rubber band, you know, paper clip guns at each other, and they're doing stupid things. Like, kids are stupid. If you have kids, get an umbrella.
Well, you could always back over a little kid in your driveway. You know, I mean, it's got to be several $1 million just to do that.
Anytime a kid gets hurt, you know, I mean, unless you live with your children are precious, right? Like, I'm just kidding. Sure. I love my children.
Yeah, that's true. Yeah.
I can't wait for them to go to college. It'll cost me about the same. Yeah. But they'll be somewhere else.
All right. So, real quick, we don't have a whole lot of time left. What should people do if they get their insurance canceled because of the wildfire risk? What are the steps they should take? And also, an ancillary question: what do you think about having shake roofs on houses if they're going to do a replacement? Yay or nay?
Oh, nay. If you put a shake roof on the house, you might as well build the roof out of gasoline in California. Like, if you're putting a shake roof on a house in California and you tell an underwriter you did that, they're going to think that you're an idiot. Like, they won't, even if they could write it, they won't write it because they'll think, who does that in all of this, right?
I thought they were treated or fire resistant.
It doesn't matter.
Okay.
Anything will ultimately burn. If it's made of wood, it's verboten. Okay. Most carriers won't even touch it.
Great.
If they're losing their coverage in California, I mean, the thing to do is, like, State Farm has a lot more appetite right now than some other carriers in California. I don't know what kind of bet they're making, but we moved a lot of people who've called us and said, you know, there's a couple of State Farm agencies that we've used. That's someone I check very carefully to see if they're willing to do it, because before I put someone in an admitted plan or a excess and surplus lines carrier, which I don't want to go into that too much, but I mean, there's carriers that you have fewer rights and less coverage. It's better to have an admitted carrier that's where there's some oversight by the Department of Insurance. So, you know, we've looked at Farmers and State Farm for some of those. They have some pretty good underwriting. And so we've sent a lot of business to those people. So if someone loses coverage and they have a question, we're always happy to get on the phone with them, map the house and say, hey, here's where we think that you would be best served. We're all working together in this right now because it's the right thing for the client, is the right thing to do.
Yep.
So,
and they can also go to the FAIR plan if they have to, right?
Yeah. And FAIR plan, it's not an option I love. I'm just going to say that there's so much business going into the FAIR plan. The FAIR plan is supposed to be supported by the carriers that do business in California. That market is shrinking, and the FAIR plan is growing. So, as a financial advisor, if I have money going, shrinking in one pot but growing in another, I have more liability. I mean, what does the math look like on that if there's a big loss, right? Yeah. And there's going to be. So if we can avoid the FAIR plan, we do. Sometimes you can't. You just have to use the FAIR plan right now.
Okay, great.
Okay.
Last question.
Yep. Earthquake insurance, yay or nay?
It depends, right? So
you are a lawyer after all. I know you.
I know. Yeah, I'm never going to say yes or no, right?
But the people of California want to know.
So So earthquake insurance, about 15% of people purchase earthquake insurance in California. In my agency, that number is like 65%. And here's what happens in an earthquake. If you lose your house, your mortgage company can't chase you forever. So you can default on the mortgage and they have to forgive the loan. And then you get a 1099 from the lender. And so now you have to pay capital gains on the loan forgiveness, right?
Wow.
If you're young, right, no problem, but if you're my age, I don't know that I want to pay taxes on it. And I don't know if I want to like let a loan go. And I don't know if I want to try to get rid of that through bankruptcy. So earthquake insurance is, I think of it as a liquidity policy, because remember, if all these houses get damaged, like they have, since 2017, every year we've had this huge demand surge. Earthquake is going to cause a demand surge. So if you have $1 million home, I'll use $1 million because it's easy, with a 15% deductible, you're going to get $850,000 from the carrier. The house is probably going to rebuild for $2 million. So a lot of people would say, well, I'm not going to buy that. There's no value to it. Well, people with low mortgages could pay off that loan or use that money for liquidity to buy another home or to go someplace else or, sell their lot. Some of those lots are very valuable up in like the Oakland Hills and things like that. So I would say if you buy earthquake insurance, think of it as a liquidity policy and not a replacement cost policy, and then have a plan. What would I do? Because a lot of people just go ahead and buy it and they think, I'm going to rebuild my house. Well,
interesting.
Would you put another $1 million of basis into your house at this? You know what I mean? Like, because if you have to dump all that money in to rebuild your house, you're taking a lot of money that you were using for other stuff, like investments. Is the house really going to appreciate at that rate? Or do you, in low interest rate environment like we were in a few months ago, it's like, 3% was, free money, right? Yeah. So I would much rather have I'd much rather have a mortgage of 3% and take my chances in the market. So it's a question of how much equity do you have and what do you do? And again, I recommend building a spreadsheet because I'm a geek and
it's complicated. Yeah, I get it.
We get along so
it's a lot more complicated than
a spreadsheet.
Yeah.
A lot of our clients like spreadsheets. They all
we're like, I don't know, 70-30 on that.
I'm
70
in the middle.
Get away from
I like
me
it. I could just talk through it too, I like the back of the napkin approach too.
Well, you're old school.
Yeah. So Brian, if people want to get a hold of you, how do they do that?
They can just go to there it is down there. Trouette.
Yeah, but some people are listening to this. They can't. It's
they can call. Our number is 925-327-1020. My last name is spelled Trouette. And if you Google that name, you're only going to get me, probably.
That's great.
You're going to see my website and you'll see presentations that we've done for Financial Planner Association, things like that. But I'm really easy to find if you're, if you want to talk. And I give away free information. I'm a believer in, useful information. So if someone has just a question or something, or they're working with someone already and they want to know if it's fair, I'll spend 5 minutes and talk to them. They don't have to buy anything from us to get some value, and I'm happy to do it. So.
Yeah. That's
you
great.
really are
That's
a
great.
shining example of being an advocate for consumers.
Yep. And plus being a really good human being as well. So Brian Trouette, thank you so much for being our guest today. People, I think, really have a much bigger appreciation now for what they're dealing with in terms of their own liability insurance and where they can turn for help. So thanks, Brian. Appreciate it.
Thanks for having me on. I love your podcast.
Absolutely. Thank you very much.
Thanks.
Thank you very much.
Talk to you soon.
Yep.
Or hopefully not.
Hopefully not.
Hope I don't have to call him again. Anyway, thank you so much for joining us on A Place of Possibility today. We have our new ebook, The Investment Answer, that we're offering. Please send us a message if you want a copy of that.
Yep.
If you want to schedule a meeting with us, you can get to our Calendly and pick your date and time, get a consultation. You can also write to us anytime at info@aplaceofpossibility.com. Questions, topic ideas, we totally want to hear from you.
We'd love to hear from you. Yep. Thank you so much. Thank you very much for being here with us. And remember, you're invested and so are we. Until next time, take care. Bye-bye.